Las Vegas. A weekday morning in March 2014, a mother buckles a 10-year-old into a 2005 Chrysler van. The girl has a fever of 103 and her asthma is closing in. The mother turns the key and the engine doesn't answer. No click, no grind, nothing under the hood. Nothing is broken. Behind the dashboard, zip tied to a bundle of wires, sits a black plastic box about the size of a deck of cards. 3 days earlier, a car payment came due. This morning, from an office 300 miles away in Mesa, Arizona, someone opened a circuit with a single click. To move the van, she needs $389 she doesn't have. This is how a late payment becomes a stalled engine. With no judge, no tow truck, no courtroom. The questions are how a box that small took the car, and why the one agency that finally saw it chose, years later, to look away. To understand the box, start with the money behind it. After the 2008 crash, millions of Americans came out the other side with wrecked credit. Scores at or below 640, the line the industry calls subprime. They still needed cars to get to work, and Wall Street, hunting for return in a world of near zero interest rates, found it could bundle those car loans into bonds and sell them. Demand for the bonds pushed lenders to write more loans faster to riskier borrowers. By early 2014, subprime auto lending had swelled past $140 billion in a single quarter. That handed lenders a problem. If you lend $8,000 to someone with a broken credit score and a thin bank account, you already expect a share of them to fall behind. The old answer was repossession. A tow truck, a skip tracer hunting an address, court paperwork, weeks of cost and uncertainty, often over a car worth less than the chase. The box replaced all of it. A small starter interrupt device wired to the ignition, married to a GPS antenna and a cellular chip, meant the lender no longer had to find the car or send anyone. It could reach into the vehicle from a screen. That one capability rewrote who a lender could say yes to and on what terms. People who'd once have been turned away drove off the lot, often at rates north of 20%. On one condition they rarely noticed: the lender kept a switch. Most people picture repossession as a last resort, something that happens after months of missed payments, warning letters, and a court's blessing. The device collapses that timeline into a click through a chain you can photograph at every step. It begins on the dealer's lot. Before a subprime buyer drives away, an installer runs a cable from a small module, a pastime unit, a Spirion Gold Star, or one of a handful of rivals, into the car's starter circuit. The box is tucked behind the dash and zip, tied out of sight. A GPS antenna gives it a location. A cellular chip gives it a voice. From that moment, the car is a node on a network its driver will never log into. The far end of that network is a screen. In a collections office, a servicer opens a map, and every financed car is a dot. Click a dot, and a menu appears: locate, disable, enable. The same software that shows where a car slept last night can, with one more click, make sure it doesn't start tomorrow. Between the payment and the punishment sits a countdown you can hear. As the due date nears, many devices start to beep from under the dash. A soft, nagging tone that grows more insistent the closer the deadline gets. On some contracts, staying mobile means keying in a code each month. A fresh string of digits the lender releases only after the payment clears. Pay and the code arrives. Miss, and the beeping counts you down to a car that won't move. Here is the part that changed the industry. A traditional repossession cost a lender real money. Hundreds of dollars, weeks of labor, a tow truck, and someone to drive it. The box drops that cost to almost nothing. Recovering a car stops being a hunt and becomes a red dot and a click. When the price of enforcement falls that far, the math of lending flips. A borrower a lender would once have refused. Too risky, too likely to vanish, turns profitable. Because the collateral can be frozen in the driveway the instant a payment slips. The device isn't a credit check, it's a leash. And it lets the lender hold a rope on the exact person the numbers said to walk away from. That's the trait at the center of every one of these loans. The box is what makes a yes possible. It's also a debt collector that never goes home, riding in the passenger seat, wired to the key, counting the days. Follow that leash into real driveways, and the same tool produces very different mornings. In Covington, Louisiana, a collections manager named Lionel Vade ran about 880 of these accounts from his office, each car a marker on a map. He described his method as patient. A phone call first, then a visit, and only after roughly 30 days of silence would he freeze a car, usually while it sat at home or work. If someone had a real emergency, he said, he'd switch it back on. He also summed up the reach the tool gave him in one flat sentence. I have disabled a car while I was shopping at Walmart. The same click from a checkout line. 300 miles from that office, the mother in the Chrysler van lived at the other end of the range. Her lender CAG Acceptance of Mesa, Arizona, disabled her van not once but 4 times in a single year. In March, again in April, again in June, each time demanding money before the engine would turn over. According to payment records later reviewed by the New York Times, she wasn't actually in default on any of those 4 occasions. The box had been switched, and the switch was wrong. And there's the edge of this story that has never been settled. In testimony to Nevada lawmakers, a 31-year-old woman said her car, financed through that same lender, shut down while she was driving, sending her sliding across a 3-lane Las Vegas highway. Device makers insist that can't happen their units. They say only stop a car from starting, never kill one already running. Whether her account describes a malfunction or something the machine wasn't supposed to be able to do has never been resolved. What's certain is that for a few seconds on that highway, she believed the car had decided to kill her. For years, the law barely saw the box. The objection is old and simple. In most states, a lender can't just take your car the moment you're late. Repossession has rules and self-help has limits. Lawyers for borrowers argued that freezing a car days after a missed payment was a repossession in everything but name, stripped of every protection. In 2012, Wisconsin's financial regulator agreed, calling a disabled car the functional equivalent of a seized one, an improper repossession. But Wisconsin stood nearly alone. Most states allowed the devices as long as the buyer was told they were there in the paperwork signed on the lot. California eventually wrote rules, warnings before a shut-off, a final notice 48 hours out, a way to restart the car for a day in an emergency. But rules like that assume the lender's system works exactly as promised. The sharper opponent came later, and it was federal. The Consumer Financial Protection Bureau began flagging starter, interrupt abuses in its examinations, and in the summer of 2023, it named the problem plainly, faulting lenders for engaging devices in ways that interfered with driving. Then it put numbers on it. That August, the Bureau sued a Georgia servicer, USASF, which handled loans for a buy, here, pay, here chain called US Auto Sale. According to the complaint, the servicer had wrongly disabled borrowers' cars at least 500 times. It had set off warning tones, that beeping under the dash, some 1,000 times against people who had already paid or were never in default. At least 1,500 times, it froze cars after promising specific customers it wouldn't, and it seized vehicles it had no right to take, including 4 belonging to active duty service members protected by federal law. Here's where even a determined regulator hit a wall. Those are allegations, not a verdict, and the company on the other end was already gone. US Auto Sales had wound down most of its business months before the lawsuit landed, leaving wrongly stranded borrowers to collect from a shell. The watchdog had finally described the machine in detail, just as the thing it was describing dissolved. A lawsuit against a collapsing company is not a resolution, and the device didn't go away. It stayed legal across most of the country, Still standard equipment on subprime lots. Still one click on a screen. Then the ground shifted, not toward the borrower but away. By 2025, Americans were falling behind on their car loans at rates not seen in decades. That September, more than 6% of subprime borrowers sat at least 60 days past due. The highest figure since the tracking began in 1994. More stranded cars, more red dots. More mornings like the one in that Chrysler van, arriving just as the referee started walking off the field. The same bureau that had counted those 1,000 warning tones proposed that year to shrink its own oversight of auto lenders from more than 60 companies down to roughly 5. A line drawn high enough that it might supervise no subprime lender at all. The agency that learned exactly how the box worked was getting ready to stop watching the people holding it. Right as the number of people at risk climbed toward a record, the exploit wasn't closed. The eyes on it were. And the box itself is disappearing, not because anyone banned it, but because the car is swallowing it. In 2023, Ford filed a patent for a vehicle that could switch off its own features one by one, the infotainment, then the air conditioning, then the door locks, and in a self-driving version, drive itself to the impound lot or to the scrapyard if it wasn't worth towing. Ford quietly abandoned the application months later, but the direction was already set. The cheap plastic module zip tied behind a dashboard was only the crude first draft. The finished version is the connected car itself. No separate box to find, no wire to trace, the switch built in at the factory. The mother in Las Vegas eventually paid to start her van. Somewhere in a database, her car is still a dot.